The Personal Financial Axiom, the foundation of financial independence. The first principle extracted from the foundational texts, the richest man in Babylon, rich dad, poor dad, I will teach you to be rich, the total money makeover, your money. Or your life, the millionaire next door, the automatic millionaire, the simple path to wealth, is that personal finance is fundamentally a game of cash flow, asset accumulation and expense control, governed by habit and discipline, not income level. The principle of controlled cash flow. The pay yourself first mandate. The most fundamental and universal truth is, a portion of all earnings belongs to the future self and must be saved, invested first. This is the pay yourself first mandate, the core lesson of Clayson and the operational principle behind box automation and Sethi's conscious spending. It is not about what is left after spending, but what is intentionally set aside before. Spending. Savings, investment, income, intentional savings, investment. This, inversion of the traditional formula, text savings, in-text income, in-text expenses, is the financial mechanical truth that forces a shift in priorities, immediately turning a portion of one's labor into capital. The principle of asset. First, liability definition. The true balance sheet. Kiyosaki's core contribution simplified is the distinction. Assets put money in your pocket, liabilities take money out. A primary residence is often a liability dressed as an asset. True financial independence is achieved not by the size of one's income, but by the size and quality of one's asset column. Those income-generating holdings, stocks, bonds, real estate, businesses, that produce passive cash flow. The foundational truth is that this cash flow, not a salary, is the sole engine of long-term financial freedom. The principle of frugality and optimization. The spending scrutiny, from the millionaire next door and your money or your life. The principle is that wealth is more often a result of high savings rate and modest living than high income. The goal is to convert earned income into invested capital as efficiently as possible. This requires an almost surgical approach to consumption, scrutinizing every expense as a trade-off against potential long-term freedom. Robin and Dominguez formalize this with the concept of the crossover point, where passive investment income equals monthly expenses, the mathematical definition of financial independence. The principle of debt elimination and safety. The bedrock of stability. Ramsey's primary principle is the need to eliminate non-mortgage debt as a foundational prerequisite for wealth building. Debt, particularly high-interest consumer debt, is a guaranteed negative return on investment that functionally lowers one's net savings rate to zero or below. This initial step of securing a financial foundation, emergency fund, debt-free living, provides the necessary anti-fragility, Taleb's concept applied personally, to withstand inevitable personal economic shocks, preventing forced liquidation of assets during market downturns. The investment mandate, strategy, valuation, and simplicity. The investment classics, The Intelligent Investor, Security Analysis, Common Stocks and Uncommon Profits, The Little Book of Common Sense Investing, A Random Walk Down Wall Street, The Simple Path to Wealth. Resolve into a core dual-path mandate. Invest only with a calculated margin of safety based on intrinsic value, or, failing that, invest broadly, cheaply, and consistently over long periods. The principle of intrinsic value and margin of safety, value investing. Graham, Dodd, Fisher, Klarman, Marx, and Pabrai all converge on the single most crucial investment axiom. Price and value are not the same, and investment is only prudent when price is significantly below the conservative estimate of intrinsic value. This difference is the margin of safety, the only true defense against the inherent uncertainty and unpredictability of the market. Text, margin of safety, or text intrinsic value. In-text market price, intrinsic value. Determined through rigorous analysis of a business's tangible and intangible assets, earnings power, management quality, Fisher's qualitative factor, and future prospects, not its current market sentiment. Investment, the act of committing capital based on this valuation disparity. Anything else is speculation. Graham. The principle of business ownership and compounding. The teachings of Buffett and Munger, captured in the essays and the Snowball, distill Graham's philosophy into: buy a piece of an excellent business at a fair price, not a mediocre business at a bargain price. The primary engine of wealth generation is compounding, the geometric growth of returns on initial investment and prior returns. The longest-term investors are successful because they allow compounding to work uninterrupted, protected by the quality of the underlying business. The principle of market efficiency and low-cost diversification, index investing. The counter axiom, championed by Bogle and Malkiel, is based on a high degree of skepticism regarding individual value-finding ability. The market, on average, is efficient enough that most attempts to beat it through active management fail after accounting for costs and taxes. The irreducible truth for the vast majority of investors is that the optimal long-term strategy is a diversified, low-cost index fund portfolio held through all market cycles. Siegel and Collins provide the evidence and philosophical framework that stocks are the superior long-run asset class. The principle of simplicity and consistency. Whether value investing or indexing, the overarching principle is simplicity and consistency over complexity and activity. Investment success is a function of time and discipline, not market timing or day trading. The constant repetitive action of investing new capital, dollar-cost averaging, and allowing compound returns to accumulate is the primary force, a truth evident in the works of Bach, Collins, and Bogle. The psychological imperative, the behavioral edge, the behavioral finance school, the psychology of money thinking fast and slow, irrational exuberance, manias, panics, and crashes, the little book of behavioral investing misbehaving, extracts the principle that the greatest risk and the greatest opportunity in finance are human emotions and cognitive biases, not economic variables. Investment success is ultimately an exercise in self-mastery. The principle of rationality as a limited resource. Kahneman and Thaler establish that humans operate with two systems: System 1, fast, emotional, intuitive, and System 2, slow, rational, deliberate. Financial decision-making is overwhelmingly hijacked by System 1, leading to predictable biases. Loss aversion. The pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain, causing premature selling of winners and holding on to losers. Confirmation. Bias, seeking out information that validates pre-existing beliefs, herding social proof. The irrational desire to follow the crowd, which fuels bubbles and crashes. Schiller-Kindleberger. The first principle here is: acknowledge and systematically mitigate one's own behavioral weaknesses, as the market is a wealth transfer mechanism from the impatient to the patient. The principle of time arbitrage. Patience as an asset house's central truth is that the single greatest edge an individual investor possesses is a long time horizon and the emotional fortitude to do nothing during periods of market stress. True alpha, outperformance, often comes not from superior stock selection but from time arbitrage, the ability to think in decades while others are thinking in quarters or days. The compounding of a few good decisions left untouched overwhelms the results of many complex, emotionally charged trades. The principle of asymmetry and the extremes, Taleb's framework. Taleb's work, The Black Swan, Fooled by Randomness, Anti-Fragile, introduces the principle of extremistan versus mediocristan. Financial outcomes are dominated by high-impact, low-probability events, black swans, that are unforecastable. The core implication is that reliance on normal distribution statistics and historical data for risk modeling is fundamentally flawed. Risk mitigation. Focus less on predicting the next crisis and more on structuring a portfolio that survives and benefits from unpredicted chaos. Anti-fragile. The gambler's fallacy. Recognizing that much of perceived skill in finance is simply the product of luck and favorable randomness. The market reality. Risk, crises, and narrative. The narratives and advanced analysis books, Liar's Poker, The Big Short, Flash Boys, Manias, Panics, and Crashes Against the Gods, synthesize the reality of the financial ecosystem. Markets are not perfectly efficient or rational mechanisms, but complex adaptive systems driven by risk, credit cycles, and human-crafted narrative. The principle of credit cycles and human recurrence. Kindleberger's historical analysis confirms the principle that financial history is cyclical and repetitive, not linear progress. Every crisis follows a predictable pattern: displacement, right arrow boom, right arrow euphoria, right arrow financial distress, right arrow panic, right arrow crash. The root cause is always the same: excessive leverage, debt, and the suspension of disbelief regarding risk. Lowenstein, Sorkin, and Ferguson provide the modern case studies of this timeless pattern, from LTCM to the 2008 crisis. The greatest risk is always perceived to be non-existent. The principle of asymmetric information and agency. Conflict. Michael Lewis's work reveals the operational principle that financial markets are riddled with severe information asymmetry and agency conflicts. Asymmetric information. The system is structured so that insiders, faster traders, flash boys, or creators of complex products, The Big Short, possess critical, timely information or a deeper understanding of risk that is unavailable to the general public. Agency conflict. The primary goal of financial intermediaries, banks, brokers, money managers, is often to maximize their own fees and bonuses, which frequently runs counter to the best interest of their clients. The principle of narrative and pricing Schiller's work on irrational exuberance and Soros's concept of reflexivity in The Alchemy of Finance establish that prices are determined not solely by intrinsic value, but by a feedback loop between fundamental reality and the prevailing market narrative, or story. A compelling narrative can temporarily detach price from value, but reality, the fundamental, eventually reasserts itself. Soros refines this, arguing that the investor's perception influences the fundamentals, which in turn influences the perception, a non-linear, self-reinforcing process. The Entrepreneurial Vector, Leverage and Value Creation. The Wealth and Entrepreneurial Mindset texts, Rich Dad, Poor Dad, Think and Grow Rich, The Millionaire Fast Lane, The 4-Hour Workweek, introduce a separate but related principle. The fastest and largest accumulation of wealth is achieved not through saving salary, but through creating and controlling a leveraged asset that solves a market problem. The principle of leverage, LOCK, entrepreneurial wealth, is accelerated by the ITBI, intentional application of leverage, defined not just as debt, but as LOCK, labor of others, capital of others, customers, knowledge. Control. The entrepreneur controls the value creation mechanism, the business, rather than merely selling their time within someone else's mechanism, the employee. Scalability. The business model must be decoupled from the owner's time, the 4-hour workweek, allowing for a non-linear, M.J. DeMarco's fast lane, increase in income. The principle of definite purpose and mindset. Napoleon Hill's foundational truth is that the accumulation of great wealth begins with a definite burning desire, purpose, a detailed plan, and an unwavering belief in one's ability to achieve it. Financial success is as much a psychological and philosophical exercise as it is an economic one. This principle underscores the necessity of persistence to overcome inevitable setbacks, a common theme across all successful business biographies. The snowball, the outsiders. The principle of value creation. The ultimate economic principle is that sustainable wealth is a result of providing massive value to a large number of people. The financial reward is a proxy for the size and effectiveness of the solution provided to the marketplace. This links back to the investment mandate. The investor looks for businesses that create value. The entrepreneur builds them. The philosophy of capital, purpose and utility. The final philosophical texts, Your Money or Your Life, Die with Zero, Principles, Life and Work, extract the ultimate principles regarding capital. Money is merely a tool, and its primary purpose is to fund life experiences and align with core values, not to be maximized for its own sake. The principle of financial freedom versus financial maximization, the FIRE axiom. The true goal of finance, as defined by Robin and Dominguez, is financial independence, FI, and life energy conservation. The pursuit is not to accumulate the largest possible dollar amount, but to optimize the ratio of capital to freedom. Financial independence is achieved when one's invested capital can generate enough income to cover expenses, liberating one's time, life energy, from the necessity of labor. The principle of life optimization. Die with Zero Perkins's truth is that money has a time-sensitive utility curve. The financial purpose should shift from accumulation to optimization of life experiences, while one has the health and vitality to enjoy them. This introduces the concept of intentional spending and optimal distribution of assets throughout one's lifespan, recognizing the diminishing marginal utility of late-life wealth. The principle of strategy and systematic decision-making, Dalio's contribution, is the meta principle. Success in finance and life is best achieved by codifying one's decision-making process into explicit written principles to remove emotional interference and ensure consistency. This involves radical truth, being brutally honest about one's own weaknesses and reality. Risk, parity, structuring investments and life to benefit from a variety of future states, creating a portfolio that performs acceptably under any economic regime, the all-weather approach. Comprehensive synthesis. The irreducible core narrative. Across the 46 texts, a single integrated narrative emerges. Financial success is the mechanical, emotional, and philosophical integration of two core actions, saving and investing. The starting line, personal, axiom. Success begins not with a large income but with the discipline to pay yourself first, turning a portion of your labor into capital that is protected from consumer debt. This creates the seed money and the foundation of anti-fragility required to withstand life's randomness. The investment engine, mandate. Once capital exists, it must be put to work by acquiring income-producing assets. The investor has two rational paths. The selectivist path, rigorously finding a margin of safety in mispriced businesses with superior management and strong competitive advantages, value growth. The default path, relying on the proven, market-wide engine of global economic growth through a diversified low-cost index fund held consistently for decades. The master key, psychological imperative. The single greatest determinant of success is emotional control and patience. The market's high volatility and extreme events are designed to separate the fearful from their capital. Patience, time arbitrage, and a refusal to sell during crises are the only true source of alpha, outperformance, for the individual. The ROI. Investor must be prepared to be a lonely contrarian when market euphoria reigns and when panic strikes. The acceleration, entrepreneurial vector. The fastest route to large-scale wealth is not saving a salary, but by creating a leveraged, scalable business that solves a recognized market problem. This shifts one's financial identity from labor seller to capital owner and value creator. The ultimate purpose, philosophy of capital. Money is not the end goal. It is the tool to purchase financial independence, the freedom to control one's time, life energy. The ultimate metric of success is not net worth at death, but the optimal deployment of capital throughout life to maximize experiences, align with purpose, and live a principled life. The greatest risk is not the stock market, but spending one's life chasing a number that ultimately arrives too late to be fully utilized. This entire library, spanning from ancient parables to modern behavioral science, ultimately delivers one cohesive message. Build a robust financial life based on disciplined saving, invest in productive assets at rational prices, and maintain the emotional fortitude to compound wealth over time, recognizing that true wealth is freedom, not just money.